Free cash flow valuation is one of the most widely used valuation approaches by the analyst. If you talk to two analysts, at least, or you'll find that two are saying that they both use the free cash flow valuation in their valuation report. So you probably can recall when we talked about the discounted dividend valuation, we provided you the avenues in which the free cash flow valuation becomes appropriate. So I want you to recall those points. So one point we mentioned that if the company's dividend, the company is not dividend paying, or the company is dividend paying, but the dividend does not have a predictable relation with the profitability. In that case, the alternative can be a free cash flow valuation approach. And another can be if your mindset is that you want to take the control of the company. In that case, the free cash flow valuation is a good approach and is also a recommended approach, I must say. So if you go for making the valuation report for your company in your career as an analyst, it is very common that you'll be using the free cash flow valuation. So probably you have learned about the free cash flow, the term from some other courses, like the analysis of financial investment. But today we like to look at the definition of the free cash flow valuation first. Then we like to see that how can we calculate it using the definition of the free cash flow. So first of all, look at the definition of the free cash flow. What do we mean by the free cash flow? So we have two flavors of free cash flow. One is free cash flow to the firm, and another one is free cash flow to the equity. So the free cash flow to the firm is from the perspective that firm is provided with capital by the capital providers, which include the bondholders, which include the equity holders. So the cash flows the firm produce, on that cash flow, these capital providers have the claim. So free cash flow to the firm represents the cash flow available to the capital providers of the firm after meeting up all the necessary expenses. So when I mean necessary expenses, what I'm actually meaning, necessary expenses include all operating expenses. In addition to the operating expenses, firm need to maintain some expenses to make sure that firm will be able to continue its business. Firm will be able to sustain its business. So which includes, you probably are familiar with the fact that if the firm wants to continue, if the firm wants to grow, the firm needs to make a investment in its capital expenditure, needs to make investment in working capital, these things. So after meeting up all these expenses, the cash flows available to all the capital providers of the firm are known as the free cash flow. Free cash flow to the firm, specifically when I'm meaning the all capital providers. So capital providers include this group. You see the item, the cash flow, the common stockholders, the debt holders, the preferred stockholders, these are commonly known as the capital providers. Okay. So another way of looking at the free cash flow is to think of that free cash flow to the equity holders. So here we are skipping other capital providers. We are only considering which capital provider? We are only considering the capital provider who provides the equity capital. So again, when we consider the free cash flow to the equity holders, we skip the cash flows available only to the debt holders, only available to the preferred stockholders. So we make the calculation in a way so that we can get the cash flow only available to the common stockholders. Now, the free cash flow has very specific definition, what we mentioned right now, conceptually. So it is not comparable to any other definition of the cash flow. You probably can recall in the previous class when we provided you the enterprise value relative to EBITDA based multiple. We provided you 3 or 4 definitions of cash flow, or 3 or 4 forms of cash flow, including the cash flow from operations, the EBITDA, then free cash flow to the firm, this cash flow measures. But no other definition of cash flow is as comprehensive as the free cash flow to the firm. And the free cash flow to the firm is the most ideal definition of the cash flows available to the capital providers or to the equity capital providers, and the most purified form of the cash flows. So that is why the free cash flow valuation is most widely acclaimed form of valuation, and it is mostly is one of the most credible form of valuation. So if I want to get the equity value, what are the ways I can get the equity value? So let me write something so that you can understand what I'm trying to mean. To get the equity value, we have 2 ways. One is very straightforward. That means we have the free cash flow to the equity holders. And very ideally speaking, it should be discounted by required return on equity or cost of equity. So let me write it in this way. And there is, summation of all the present value of this. Okay. So in this way, we can get the value of equity. But sometimes the way of calculating the equity value, taking the free cash flow to the equity, is not a good approach. I will mention it shortly, why it is not a good approach to use the free cash flow to the equity, because there might be some problems. Before that, I would like to show you what is another alternative to come to the same equity value. That is, if we take the free cash flow to the firm, as you already have recognized that free cash flow to the firm is available to all capital providers of the firm. So the discount rate, what I'm taking, or the interest rate, what I'll be taking in the denominator, should be a reflection of something which is the average cost of capital, or ideally speaking, weighted average cost of capital. So if I use this, I will get something which is called the value of operating asset. Value of operating asset of the firm. So firm has the financial asset, firm has operating asset, but mostly the firm consists of the operating asset. So by doing this, you get the value of operating asset. Now, when you add the value of operating asset with value of cash and marketable securities, we get the enterprise value. We get the entire firm value. Okay, we get the entire firm value. Now, from this entire firm value, if we subtract the market value of debt, we should get the same equity value, which we get directly here. just by discounting the free cash flow to the equity by the cost of equity. Now you see there are two approaches to come to the same thing, equity value. Now the question is, will the free cash flow to the equity and the free cash flow to the firm be available always and be easy to handle when these are available? First of all, we need to think of that sometimes the free cash flow to the equity, I mean the firm, when some firms are highly levered firm, when some firms are highly levered firm, for those firms, you should think of that their interest expenses will be a very high amount. So when interest expenses will be a high amount, you should think of the cash flows available to the equity holders is likely to be very low or likely to be negative. So when within the forecast horizon, the analysts see the free cash flow to the equity holders becomes negative or very low, very minimum within the forecast horizon. In that case, using the free cash flow to the equity to come to the equity value might not be a good way. So in that case, the recommended approach is to use the free cash flow to the firm. So first point I mentioned, when the firm is highly levered, which is likely to cause the free cash flow to the equity a negative value. This is the number one. Number two, sometimes we see the firm's capital structure or the way firm finances its operation is likely to be very unstable. It's likely to be very unstable. Now, when it's likely to be very unstable, I mean, sometimes firm is increasing its debt, sometimes firm is decreasing its debt. In that case, it is likely to affect the WSCC or WACC. I mean, it will be affecting the WSCC. So you're not getting a reliable estimate of the WACC for the future when the firm is using a capital structure which is very much fluctuating. In that case, I mean, we have the WACC. And in that case, at the same time, when the firm is using the unstable capital structure, it will also be affecting the cost of equity. So you probably can recall that the cost of levered equity gets affected, unlike the cost of unlevered equity, because of the changes in the capital structure. So in this fluctuation, the WSCC, because it is a weighted average cost of capital, it is likely to be more stable than this levered cost of equity. So that's why it is recommended to use the free cash flow to the firm when the firm's capital structure is likely to be unstable. So these are the ways that how can we come to the equity value. So I see some are raising hand. So Muttalib, would you please speak out?
স্যার ডিএমভি দিয়ে কি বোঝাচ্ছে?
Sorry?
স্যার এই যে ইভি মাইনাস এন্টারপ্রাইজ ভ্যালু থেকে ডিএমবি কিছু একটা মাইনাস করা হয়েছে, ডিএমবিটা আসলে কি স্যার?
It is not DMB, it is the market value of debt. By D I have written debt, and by MB I have mentioned the market value.
Yes sir, got it.
Okay, thank you. I see it. Samin Yasir.
Assalamu alaikum, sir. Sir, I was wondering, the points you gave, you said, yeah, if my capital structure is unstable, then the WACC will be changing, right? Then how can I use FCFF?
WACC will be, I mean, the WACC will be also changed, and I mean, the cost of equity will also be changed. but the fluctuation in the WACC will be averaged out because it is a weighted average. Okay, so I mean, using this is safer. I mean, the fluctuation is likely to affect this less. Obviously, it will also be fluctuating, but this is likely to be affected much.
Also, sir, in the equity value formula, the first one using the FCFE, there's a summation sign, but like, there's no T or N or anything. So is
Yeah,
the infinite
here.
period?
You want the summation here?
Yes, sir. Like for this summation, does this go on until infinite period? Like-
Yeah.
Okay, got it. Thank
It
you.
will go in. Okay.
স্যার 1 নাম্বার লিমিটেশনটা আবার একটু বলা যায়, হাইলি লেভারড।
When the firm is highly levered, obviously we expect what the firm's interest payment is likely to be a high value. So when the firm's interest payment is likely to be a high value, it is likely that the cash flow is likely to be taken by the debt holders, most of the cash flows. And if the most of the cash flows are taken by the debt holders, there is a chance that in some periods or in some initial periods, in your estimation, the free cash flow to equity becomes negative.
Yes, sir.
Okay, so for avoiding that chance, we are recommended to use the free cash flow to equity. Okay,
Yes, sir.
have we got 2 points?
Yes, sir.
So
Sir, I
try,
was so confused about the levered equity. So what are these?
sorry,
Levered and unlevered cost of equity.
yeah.
Like, I was confused why they varied.
They should vary. Okay. This is in fact the corporate finance issue. So what do you expect? I mean, think of it as a levered equity, cost of levered equity, and it is a cost of unlevered equity. When the firm increases the debt level or
Risk also
increases the debt to capital ratio,
Yes.
don't you think that the equity holders becomes, I mean, feel more riskier?
Yes, sir, I understand.
So they expect more compensation?
Yes.
Okay, thanks. Okay,
Sir,
so-
when the firm is highly levered, we should use the free cash flow to farm.
yeah. Yep. So, what I wanted to show you, these are the depiction, what I mean, if I want to show you, what it is actually. Farm value, we calculate using, I mean, if we use the free cash flow to the farm, here something is ignored. What is that something? That is the cash and marketable securities. Cash and marketable securities. But cash and marketable securities are, I mean, a very insignificant component compared to the value of the operating assets. That's why it is has not been mentioned. You can add it here in the farm value. Another approach, if it is not added here in the calculation of farm value, what is done, when we subtract the debt value, we think of the net debt. We think of the net debt. So what is net debt? Net debt is the value of the debt minus cash and marketable securities. What is the meaning of it? The meaning of it is, by using my available cash and the marketable securities, I can reduce my debt burden by this amount. So ideally speaking, I have this net debt available to repay. Or I have to be concerned about this amount of debt available after subtracting this amount, because I have the capability right now of meeting up this amount of debt payment. So that's why if I do not include the cash and marketable securities here, alternatively, what can I do? I can adjust the debt value by taking the by taking the subtraction of the cash and marketable securities, and this becomes net debt. Okay. So in this way, I can come to the equity value. And another approach, as I mentioned, that if we take the present value of free cash flow to the equity and discount it at the cost of equity, we can get the equity value. Okay. So far, so good. So let's try to apply what have we learned using a very simple calculation. So we have the current free cash flow to the firm, 6 million. And we have the, have we missed any? Yeah, we have missed one slide here. Okay. So if we think of that, the free cash flow to the firm is expected to grow at a constant rate. We mentioned it in the Gordon growth model, constant growth model. If we expect the free cash flow to the firm will grow at a constant rate, we can get the value of the firm using the same approach we learned in the dividend Gordon growth dividend discount model. But here, the changes will be in the numerator. We take the free cash flow to the firm, expected free cash flow to the firm for the next year. And we divide this or by the difference between the WACC, cost of capital, minus the constant growth rate. But if we take the direct approach, the free cash flow to the equity, the changes will be in the cost of equity here, but the constant growth rate will be here. But there is no such thing that the free cash flow to the firm or free cash flow to the equity will grow at the same constant rate. The way they grow at a constant rate might be different because the construction are different. Okay, so the growth rate might be different. The growth rate is not necessarily same. So this is the very simple scenario when the free cash flow to the firm is expected to grow at a constant rate. And for mature firms, these are likely to be a very close case, not the actual case, but for mature firm, these are likely to be a very close case. I mean, the closer case, but for a very, I mean, new firm or kind of a startup company, or for company like which are expected to cease its operations, this is not likely to be the case. So let's try to apply this. What have we seen in this case? We have the estimate for current free cash flow to the firm, 6 million. Target debt to capital, 25%. Market value of debt, 30 million. Shared outstanding, 2.9 million. Required return on equity, 12%. Cost of debt, 7%. Long-term growth in FCFF, 5%. So we have been provided this constant growth rate. The tax rate is 30%. So we are provided with a scenario for free cash flow to the firm. So that's why you are likely to use which one? We have to use the farm value using the free cash flow to the farm is a single stage growth. So you'll be using the WACC minus the growth rate. So before coming to this calculation, we need to think of each of the components separately. This is the estimated free cash flow to the firm. This is the current FCFF. So how can we estimate the next free cash flow to the firm? What is your expected growth rate? 5%. So if we multiply 6 million, if we multiply 6 million by what? This 5%, we are getting what? The expected free cash flow to the firm for the next year. And in the denominator, what have we need to input? We need to input the WACC and the growth rate. We have this ready-made given 5%. But what will be the WACC? I believe you are very comfortable with this calculation, but Let's do it together. We see the target debt to capital 25%. So we take the which one is the 75 is the equity to capital? Can you think of each? Equity capital 75.
Yes, sir. Makes sense.
Then we take the cost of equity. Is it here? 12%. 12%. What we are doing, we are estimating the WACC. Then we have the debt to capital. Should we take the after tax interest cost or the before tax interest cost? We have the cost of debt
After tax.
after tax because the interest is tax deductible. We get the tax advantage for having the interest payment. So it is a 30%. Now, can you ask your calculator to tell this value?
So 10.225%.
10.225%, so that we can safely use this one. So we are taking here 0.1023. Can you ask your calculator again to estimate the value of this firm under this scenario? What should be the value of this firm? We got it. Yeah,
120 million.
120,
Million.
120,
Yes, 120,574,162.
574. Okay, 57 million. So you see, keep it in your mind. In your exam, you'll see the figures in million, you see the figures in million like this large figure. Don't go for write all the numbers. Okay, so try to write the numbers in a way, but don't forget that you have calculated the figures in million. Okay, so that the chance of doing mistake becomes lower and you can save your time. There is no additional marks if you write it in full form, or there is no reduced marks if you write it in million. Am I clear? So most often we see the case that we are spending time by writing the zeros after the number to see that we are writing the required number of zeros, and we see that we have written it correctly. So try to avoid this. These are not your case. These are the case for school going children. Okay. So we have the farm value. Now, how can we come to the equity value? So you have seen that the equity value can be available by subtracting the debt value from the farm value. But if we have the cash and marketable securities, we can take the net debt by subtracting that amount from the debt value. But right now we do not have cash and marketable securities amount. We simply have the market value of debt. So this is 30 million, right? So if we subtract the 30 million from this 120.57, how much we should get for the equity value? We should get approximately a 90.57. 90.57. Do we have the number of outstanding share? We have the number of outstanding share, 2.9 million. So what can we do? We can ask our calculator to divide the $90.57 million by the 2.9 million number of outstanding common shares, so that I can get the equity value per share. Have we got it? Equity value per share.
$31.23.
$31.23. Okay. Okay. That is here, 31.2321. There might be little bit changes for decimal. That is not the big issue. Ifrat, you want to speak something?
স্যার একটু আগের স্লাইডটাতে একটু যান।
This one?
এইটা স্যার, এই যে স্যার 100 ইকুইটি ভ্যালুটা বের করার জন্য 120 থেকে 120.57 থেকে 30টা বিয়োগ দেওয়া হয়েছে কেন স্যার, এটা বুঝি নাই।
Okay. Have you listened have you heard the name of lookup SEOly?
জি স্যার।
Okay. So what is his contribution?
স্যার a is equal to l plus oe।
Equal to L plus OE.
আচ্ছা আচ্ছা, অ্যাসেটটা থেকে লায়াবিলিটিটা বাদ দেওয়া হয়েছে, বুঝতে পারছি স্যার।
Okay.
Sir,
So, yeah,
market value of debt টা কেন নেওয়া হচ্ছে? What does this mean actually? আমার তো debt payment করবো আমরা contract যে amount দেওয়া, right? নাকি এটা হচ্ছে present value of that contract basically?
in fact, I'll be paying in terms of my, the value of the shareholders' equity will be estimated by considering my liabilities in terms of market value. Uh, uh, in terms of current market scenario, the debt, what I'm incurring, what is the worth of it in the market. Don't think it that always the market value of the debt will be higher than the book value of the debt. It might be also less than the book value of the debt. So the market value of the debt ultimately matters to me. Similarly, the market value of equity matters to me. Okay. In terms of my actual incurrence, I'll have to bear the consequences in terms of the market pricing. So let's look at the definition of the free cash flow to the firm, because that will be very much useful later. So we are starting with a very basic definition of the free cash flow to the firm. We are starting with net income. We know where we get the net income. So we have the net income number. We believe that this is available to the equity holders only. But we have to add the non-cash charges, because the non-cash charges does not involve any cash outflow. So that's why any non-cash outflow will be added back. Any non-cash inflow will be subtracted out. So this consideration is made here. Then remember, we are calculating the free cash flow to the firm. So it includes the cash flow both to the equity holders, also to the debt holders. So what is the cash flow to the debt holders? That is presented here in current term. This is paid to the debt holders after tax interest expense. So that's why we are adding it back. Okay, because we are calculating the free cash flow to the firm. If it were the free cash flow to the equity, we would not add it. Okay. As I mentioned, you probably can recall in the definition, conceptual definition, we have to make necessary expenses to keep us operating, to keep us floating. So what are the necessary expenses? We already have made necessary expenses here, the operating expenses. You probably can recall that net income comes from very simplistically income minus expenses. I'm ignoring other facts. Okay. At the same time, you also have subtracted the tax payment, and that is the operating expenses you have subtracted. In addition to this, you have to make other expenses, which includes the capital expenditure, and that is here, fixed cost investment. FC investment means fixed cost investment. And then we have to make expenses for working capital. So let's talk about each of this. We already have mentioned something, but you need to recognize that from where it becomes available. So net income, you can recall that it is the last line item in the income statement, and it considers all the expenses, operating expenses, administrative expenses, manufacturing expenses, I mean all expenses. So ultimately it becomes available to the equity holders, but net income does, net income is polluted for some non-cash charges. That's why you want to purify the net income by making the adjustment for non-cash charges. So let's make the example of non-cash charges by saying the depreciation and amortization. So for depreciation and amortization, we have incurred no cash outflow. So that's why the non-cash charges is added back. And another one, as it is a free cash flow to the firm, we add back the cash flows we make available to the debt holders. So after tax interest expense is added back. And as I mentioned, the investment for fixed capital, and this is required to make the firm operating and to make the firm to grow. And the last one is the investment in working capital. You probably can recall we learned in the Excel sheet that how can we estimate the account receivable, inventory, accounts payable, each of these are the working capital items. Now, when we estimate the working capital, we have to keep some points in our mind. In this working capital estimation, which components will be in the current assets, which component will be in the current liabilities. Okay. We have to think of in our calculation of working capital investment. Obviously, this is the current working capital, say working capital 1, for year 1, and working capital for previous period says 0. These changes we want to estimate here. If this changes, say working capital in this period is 120 and working capital in this period is 80. So we require new investment of 40, and this 40 is subtracted here. I strongly believe you have learned the way of calculating this from your capital investment decision course in the NPV calculation for a project, the project cash flow. And this is similar. But here in the current asset, in this calculation, what we don't include, we do not include the cash and marketable securities, because when we calculate the free cash flow, this is the reflection of also this amount. So we do not include here the cash and marketable securities. You probably can recall, so I can't recall the term exactly. In Excel, you probably can recall that I showed you a problem which happens I can't recall exactly the term.
So do you mean circular reference?
Yeah. Thank you very much. So circular referencing. So when I'm estimating something, say free cash flow to the firm, which also has the component for cash. So if my input also has the cash and marketable securities, there is a chance of circular referencing. So this is one way that we do not include the cash and marketable securities here because our concern is to estimate the cash. And another part is that here our concern is operating investment. I mean, here, this is the investment in operations. I mean, this one, investment in current operations. So in the current liabilities part, though, by definition, we think of the short-term loan, notes payable as a part of what? Current liabilities. But we do not include this short-term loan notes payable higher in the estimation for current liabilities. I mean, we skip this calculation. We skip these components in the current liabilities, and the difference between the current asset excluding cash and marketable securities and the current liabilities excluding the short-term financing and notes payable constitutes the working capital for each period in this way. Now, if I see a positive difference, we have to make a investment. If we see a negative difference, we consider that the investment will be recovered. Okay. So we need to keep this thing in our mind in free cash flow estimation. So this is the definition. The first definition we are offering here. So try to keep this in your mind. If you think of the conceptual definition of the free cash flow to the firm, this will be, this will be very straightforward in your mind. But instead of, without understanding the conceptual background of this, you'll not be able to get this. So this reflects the necessary expenses, and this reflects the cash flow to the equity holders, and this reflects the cash flow to the debt holders. Okay, I mean, these cash flows should be adjusted for what? Necessary investment. Then this cash flow becomes available to the capital providers. Now, let me show you a list from your text, which summarizes the non-cash charges. Mutalib, any question?
লোনটাকে কেন কারেন্ট লায়াবিলিটিস আন্ডার নিচ্ছে না স্যার?
Sorry?
শর্ট টার্ম লোন বা নোটস পে যেটা বললেন সেটাকে কারেন্ট লায়াবিলিটিস কেন নেওয়া হচ্ছে না?
The idea is that we, in the working capital investment, we include here our concern is how much investment is required in current operations. So the short-term financing or the notes payable, these are not part of our, part of operation, but more, these are ideally part of our financing part. These are part of our financing. Okay. So on that ground, this amount is not, included. So here we want to think of how much investment is required. How much investment is required. So in the working capital investment, I have to subtract the current assets, current liabilities from current asset. Now, if I include something which is financing component in the current liabilities, if I include something which is in the financing part in the current liabilities, I'm not getting the actual amount, how much I should make invested or how much I should make investment. So I'm actually including the operating current liabilities, not the financing current liabilities. Okay. So they are the current liabilities, but in the our concern is to calculate the investment required for the difference between the current operating asset and the current operating liabilities. So think of it in this way.
স্যার আর কি কি কারেন্ট লায়াবিলিটিস আছে যেগুলো হচ্ছে এটাতে ইনক্লুড মানে এখানে
Only
আসবে?
only this. No, I mean the financing component. Financing component.
স্যার আমি এটা বলিনি মানে শর্ট টার্ম যে
Yeah.
বা শর্ট টার্ম যে লোনটা আছে
Okay.
এই
Okay. Look at here. Can you recall that we excluded the cash and marketable securities?
এটা ছাড়া আর
Can you
অনেক
recall?
কারেন্ট অ্যাসেট আছে
Yeah.
যেগুলো
And now look at this marketable securities is our current operating asset or current financial asset.
ফাইন্যান্সিয়াল অ্যাসেট।
Okay, in the same logic. Got it? So our concern is operating, not the financing here.
মানে অপারেটিং লায়াবিলিটিস আর কি কি আছে স্যার अवेलेबल যেটা এই ইকুয়েশনটাতে আসবে স্যার?
Financing component. If you see some component look like financing component, that will be there. So the short-term financing notes payable, this might be in different name. But by looking at the term, by looking at the nature of the term, you have to understand that should it be here or should it be here. Okay.
ওকে
Okay. So let me show you a list of non-cash items which require adjustment. So this is available from your text. So ideally speaking, this is here in the non-cash charges. So guidance for adjustment is given, but let me mention some of the items. I will not be mentioning each of these. First of all, the amortization is very straightforward. Amortization comes from the intangibles and it is a non-cash outflow. So we have to add it back, right? And before thinking of these items, we have to think of another item you probably can recall. We talked about the quality of the earnings. Can you recall the quality of the earnings or earnings quality? So which earnings are our concern? Can anyone remind
Sir,
me?
earnings that are recurring.
Yes.
Earnings which are recurring, earnings which are sustainable, earnings which are expected to repeat in future, right? Okay. So we have to, as an analyst, we have to purify our free cash flow to the firm or free cash flow to the equity for any item which is likely to be non-recurring, which is likely to be not repeating in the future, which is not likely to be connected to the core operations of the firm. Got the idea? So keeping this philosophy in your mind, read the remaining items. So restructuring expenses. Restructuring expenses. So sometimes firm needs to restructure. Say firm has closes its one product line. So when firm closes its some of its product line, they need to write off the assets connected with that product line or closed off product line. So when they want to close that product line and to sell off the asset, they need to write down some of the assets and they need to incur some expenses. So those expenses are kind of non-cash expenses. And if those non-cash expenses have been subtracted in calculation of net income, we have to add it back. At the same time, when firm makes the restructuring, they might sell off some of the asset. And from those assets, they might end up getting some accounting gain or getting some gain in terms of book value. So one of those examples is a kind of capital gain. So if it is there, we should subtract it out from the net income. So, but if there is a cash flow consequence, if there is a cash flow consequences, that will be reflected in the cash flow from investment, but that should not be added, or that should, the way it is included here, it is a kind of, the net income should be verified. And similarly, I mentioned another item, say deferred taxes. So deferred taxes comes from the situation that, say for example, we calculate the income tax expenses, and we see another tax item in the cash flow from operations, taxes paid. So if these two are equal, income tax expenses, which you see in the statement of comprehensive income, and the taxes paid, if you see these two same, in that case, there is no presence of deferred tax assets or deferred tax liabilities. But which is very common, that income tax expense is greater than the taxes paid. That means the expense what have I incurred is greater than the taxes I have paid in respective income year. So here the deferred tax liability arises. So when the deferred tax liability arises, we should see that this deferred tax liability is likely to be adjusted in the future or likely to continue in every year. So if the answer is first one, that it will be adjusted in the next year, or in the next year it will be reversed. What actually happens, because the in most of the cases, you have to complete your incurred income tax expenses. In that case, you should not be bothered about it. You should not add it back. You should not add it back. I mean the deferred taxes, which you see in the statement of comprehensive income. But sometimes deferred tax is likely to repeat. Deferred tax is likely to repeat. So if the deferred tax is likely to repeat, we should add it back. I mean the changes in deferred tax, which is presented in the, we see the deferred tax liability, and from the difference of the deferred tax liability, we get the deferred tax expenses, and we should add it back to the net income. So that's why the issue is question. I mean, we have to find the answer that whether it will be reversed shortly or it will be adjusted. It will be adjusted or reversed, or it is expected to continue in coming years. So if the answer is yes for the first one, in that case, we do not need to make any adjustment. But if the answer is 2, the number 2, which I mentioned that it is expected to repeat in future, in that case, we should add it back to the net income. This equation. So these are some advanced issues. You'll not be tested for each of this, but you should be familiar, at least the idea of this, so that you'll be aware of it. So let me show you another definition of the free cash flow to the firm, because in various ways, the statement will be presented to you, or the information will be presented to you. So you should be skilled enough to find out that it is possible to get the free cash flow to the firm calculation from it. So here you see that we are taking the free cash flow to the firm in a way after tax, earnings before interest and taxes, and we are adding back the depreciation, and we are again subtracting the investment in fixed capital and investment in working capital. Now, alternatively, what can we do? We can take the after tax EBITDA and we can take the depreciation tax shield and we adjust the investment in fixed capital and investment in working capital. Then this definition should be understood very clearly by you, because the term paper, what are you doing? The template, what have I provided to you, has used this definition of for calculating the free cash flow to the firm. So look at the cash flow to operations part, or cash flow from operations part. So as your template includes the statement of cash flows, so you have included what? You have included the estimation for cash flow from operations for coming quarters, coming periods, okay? So here in this cash flow from operations, you can recall that you start with net income and you add back what? You add back the non-cash charges, okay? At the same time, can you recall that because you have prepared using the indirect form of cash flow statement, you have taken the working capital investment. There are the changes in current asset, changes in current liabilities. Can you recall this?
Yes, sir.
Can you recall this?
Yes, sir.
So let me show you so that you can recall. So you see, cash flow from operating activities, right? So you start with what? The net income, and adjustment have been done for what? The non-cash charges. The primarily for your case, you should get the intangibles or the fixed asset depreciation. This have been added. And in addition to this, I have seen you, I have shown you a list of non-cash charges. Yeah, I have mentioned the deferred taxes, and there was a list, there the share-based compensation is also there. Yeah, employee option exercise. So these are the cases there. So you see the first part, I mean, net income has been adjusted for what? The non-cash charges. Now you see this portion. Does this portion reflect the investment, I mean, incremental investment in working capital?
Yes, sir.
So after making this adjustment, you get which one? The cash flow from operations. And this is here.
But
And this
doesn't
is,
that also include like
yeah, this is
notes
the first
payable
part.
and stuff?
Sorry,
Like that investment in working capital, doesn't it also include the notes payable and short-term financing?
you see here,
Notes payable is
you see such thing?
yes, right. I think I understand. That's in the financing section.
Yeah. Okay. So that's why we see which component missing in this new definition.
Working capital investment.
Exactly. So why it is missing? It is not actually missing. It is hidden here, right? Got the idea? Then we are adding back what? After tax interest expense, this which reflects the cash flows to the debt holders. Then we are subtracting for what? Investment in fixed capital. So let me show you the calculation in the sheet so that you will feel comfortable. I have taken this one, free cash flow to the firm. Okay. Now it starts with what? AV 217, right? So what do you expect? What is it? Any guess? Any guess?
So operating cash flow, right?
Yeah, cash flow from operations, exactly. So FV 217, it is here. You see, net cash provided by operating activities. Then, what do you expect for next item? I mean, yeah, this one, yeah. Then the next item is for capex. Okay, next item is for capex FV 224. So let me show you. I mean, this one. Okay. FV 224 is here. You see? You attempted for estimating the payment for acquisition of property, plant, and equipment. Then what do you expect for next? What is remaining?
The interest.
After tax interest expenses. So how can we calculate the after tax interest expenses? We can take the beginning balance of debt and we can multiply this by what? Any guess?
Before tax interest, right?
After tax, not before tax, right? I mean, in summation, we need to multiply it by what? After tax interest expenses. So let me show you. You see the C287. Okay, let me show you this one first. AV 166. So this AV 166 is the debt balance. So what you estimated? Yeah. Okay, you see long-term debt. Okay, then then C287 is the cost of debt and 288 is the tax rate. I mean 1 minus tax rate. Okay, 287 and 288. So let me show you there. C287 and 288. You see from here. You see average cost of debt is this one, 287, and 288 is effective tax rate. Okay, so I hope you have got it. So you'll not get confused when you see the calculation in your template that the free cash flow to the farm has been calculated in this way. But we
I
have,
have one confusion.
yeah,
So regarding the fixed capital investment, if I were to make this investment, or like if I were to pay for my capital using credit, if I bought it on credit, would that also be shown here? Or just for like cash payments for investment?
the way your financing is not matter here.
So
Okay.
did we take this figure like in the template from the cash flow statement? Then so we're only considering the cash flow?
Sorry,
If we take the figure from the cash flow statement, then wouldn't we only be considering the like the cash flow? Or like only the cash expense?
we like to, yeah, we like to include the cash expense for fixed capital investment.
So does the template also take into account any credit?
That will be reflected here automatically. When you take the, when you finance the capex by taking the long-term debt, that consequence will be reflected here. Got the idea? And investment will be here, the financing effect. I mean, if it is a credit financing, it will be reflected here.
Yes, I think I get it.
Okay. So there are other ways of looking at the same thing. but let me show you one from here. So if we have the free cash flow to the firm starting, and we want to calculate the free cash flow to the equity from free cash flow to the firm. First of all, we should subtract the cash flows available to the debt holders. Got the idea? I have the free cash flow to the firm. I want to calculate the free cash flow to the equity. I should subtract which one first? The cash
Yes.
flows available to the debt holders, right? Because I want to get the cash flows available to the equity holders. Now, another interesting point, what you need to keep in your mind, that if we make a new borrowing from the debt holders, if we make a new borrowing, we get the cash balance.
Yes, sir.
If we get the new borrowing from the debt holders, do we get the cash balance?
Yes.
And that cash balance is also available to the equity holders. That cash balance is also available to whom?
The equity.
The
holder.
equity holders. Okay, that's why the new borrowing or net new borrowing is added. Okay. Now, if you see the net borrowing is negative, automatically it will be subtracted. If you see the net borrowing is negative, when the net borrowing becomes negative, can you make a guess?
When we give loan,
Say for example, okay. Say for example, in this year, 2023, I have the debt level of 20. And in 2022, I have the debt level of 30. I have the net new borrowing or I have the net repayment of debt.
repayment.
Repayment. In that case, the net borrowing becomes negative.
Yes, sir. So if we pay more than the interest, we're incurring negative net borrowing.
Yeah. Okay. So you probably can recall that we talked about this free cash flow to the firm, this definition. So you can make simple adjustment from the existing equation to get the free cash flow to the equity holders. So look at here. Look at here. This goes to whom? Which one? The bond holders. That's why the free cash flow to the equity calculation should not be inclusion of this. At the same time, if we have the net new borrowing, that should be added. Okay. We already have seen this definition in the previous slide. Okay. Now you see that we have the cash flow from operations. Again, we are subtracting which one? We are not adding which one? Because this is the cash flow available to the bondholders. And we are ignoring it, but we are adding what? The net borrowing. So in this way, you have to think of this, and instead of memorizing it, try to get the idea how we are coming from one way to another. Okay. So if you try to rewrite all the equation, you should get this one. Okay. So these are actually the same thing. I mean, these are actually the same thing, but written in different forms. So I don't want to make the things complicated by showing the remaining definition of the free cash flow to the firm. But I'm just making one point that it is also possible by looking at the free cash flow to the firm by calculating what is the net payment to the debt holders, what is the net payment to the stockholders, and adding it with the changes in cash balance. So I'm skipping this part to make you feel comfortable with other definitions of free cash flow to the firm, but I recognize that it is also possible to look at the free cash flow to the firms in this way. So let's solve a problem so that you can feel comfortable with the equation for free cash flow to the firm. What have we seen so far? What the information we have been given? First of all, EBITDA $1,000, depreciation expense $400, interest expense $150, tax rate 30%, purchase of fixed asset, which is investment in fixed capital $500, changes in working capital 50, net borrowing 80, common dividends 200. Okay. Now, what we need to calculate? Any guess? We need to calculate the free cash flow to the firm. Okay. So we should start with what? Any idea?
So EBITDA.
EBITDA.
Because what? What's the reason that why we should start with EBITDA? Why not net income?
Sir, is it because it is a proxy to cash flow from operation?
Well, because it already
Ah.
has interest and depreciation added.
Okay, we are not using here the proxies. Okay. We need to use the free cash flow to the firm, but sometimes the EBITDA is used as a proxy of cash flow, not the free cash flow to the firm. But we'll not be using any proxy here. We will organically calculate the free cash flow to the firm. The question is, for calculating the free cash flow to the firm, you probably can recall we should start with net income. But is the net income available here, ready-made?
No, sir.
It is not available. That is the question. That's why I have mentioned that why we are not starting with net income, because the net income is not given. We need to calculate it. So let's try. Is it possible to calculate the net income? So let's start with $1,000, which is EBITDA. Is it EBITDA? Now from EBITDA, we are subtracting depreciation expense of 400. Do we have any amortization? We don't have. But we have the interest expense, right? So if we subtract the interest expense, can we get the pre-tax income? What do you think? Can we get the pre-tax income?
Yes, sir, we can.
How much it is? 550, 450, 350,
450.
450. This is, remember, I'm not writing what I'm calculating, but I'm mentioning. Okay, so try to follow what I'm speaking at the same time. So it is what? It is the taxable income. And now if I apply the tax rate, which is 30%, 30% of 450, how much? 9135. Is it tax? You feel comfortable? So if we add, if we subtract the tax, how much we are getting? 315. So what is it? Ifrat, can you tell me what have we calculated at this moment? Ifrat, are you there? Anyone wants to volunteer? What have we calculated?
The net income.
Net income.
Something important? Net income. So that we can add the we can start the calculation for free cash flow to the firm.
So I was wondering why we use this like roundabout approach. Why not directly use the EBITDA, add the depreciation tax shield?
You can use it. There is no restriction.
Okay.
Okay.
Does
We have been provided with number of definitions of the free cash flow to the firm. As long as you feel comfortable with any of the definitions, you can go with your calculation, right?
Yes, sir.
Okay,
Maybe
so,
this method helps with the tax calculation. That's why it's better
yeah,
than
Uh,
exam.
actually, you feel more comfortable with the EBIT plus depreciation tax sheet. I mean that form. I mean this form. Let me show it. Where is it? Yeah, this one. You feel more comfortable with this because you have seen it before in the capital investment decision. If I'm not wrong.
Yes, sir.
So familiar things, for familiar things, we feel more comfortable, and that is another bias, which is known as the familiarity bias. Okay, so whatever, so we have to use that one with which we feel comfortable. Okay, no worry. So you have the net income, right? Okay. Then can you recall what is the next after net income? We should add back what? Non-cash charges. Do we have any non-cash charges?
Depreciation, sir.
That is the depreciation 400. So after adding it, we should add what? We should add what? Can you recall this? Can you recall what we wrote
After
in
tax
the
interest.
after tax interest expense? Exactly. 150 multiplied by 1 minus 0.30, right? 150 multiplied by 1 minus 0.30. What is it? 105. Is it?
Yes, sir.
105. Okay. Then you should subtract something. What is that something?
Capex,
It's
sir.
capital investment.
Investment in fixed capital 500. Changes in fixed capital investment 500. Then we have anything else?
Working capital investment.
Working capital investment. This one 50. Is it positive? That means we need to make investment, right? Is it positive? That means we need to make investment 50. Now, can you please sum up this, and this?
270.
270. Okay, what is it? Free
Yes.
cash flow to the farm. Okay. Now, can you tell me that is it possible to get the calculation for free cash flow to the equity from the same information? Let me try. We have the free cash flow to the farm 270. I'm subtracting after tax interest expense, that is 105. I'm adding back if there is anything net borrowing, which is 80. Okay. Now, can you check how much it is?
$245.
245. What is it?
Free cash flow to equity.
Free cash flow to equity. So you can use any of the definitions we have provided to you to come to the same calculation. So to feel comfortable with all the equations, I want you to have a look at on all of this. But ideally speaking, most of you will not be able to recall the concept in terms of the terms in exam. So that for exam perspective, what I am wanting to emphasize, I'm wanting to emphasize on this one. I'm wanting to emphasize on this definition for free cash flow to the firm. At the same time, I want to emphasize these two definitions. One is for free cash flow to the firm. Another one is for free cash flow to the equity. But for your term paper purpose, you should feel comfortable with this because your template has been structured using this one. Okay. Happy? So don't get confused by looking at the number of ways that how the free cash flow to the firm can be looked at. You see the same calculation, what have we seen, the 270 and 245. You can come to the same calculation. Samin Yasir, are you there?
Yes, sir, I am.
You see your favorite one?
Yes, sir.
Okay, the same thing, 270. And the one which I provided to you for the town paper should give you the same thing, 270. You can verify it. And for free cash flow to the equity, you get the 245. So this is, I mean, it is from the perspective of free cash flow to the firm, from the perspective of net payment to the capital providers. So we are skipping this. But I believe that if you look at the definition of each of these, you'll find it very much interesting. Okay. That free cash flow to the firm ultimately reflects the cash flow available to the capital providers. Then that has been presented here. Okay. So we have the issues for forecasting FCFF and FCFE for the valuation purpose. And we'll be talking about this in the next class. But